day, ladies and gentlemen. Today we're here to explain one of the most important concepts in trading, whether you're trading stocks, CFDs, whether you're trading gold, whether you're trading cryptocurrency, and that's the stop loss. No one should ever trade without having a stop loss in place. Risk management is the crux and the key to becoming successful in the markets. Now, what is a stop loss order exactly? Well, a stop loss order protects profits or limits risk on an investor's open position by exiting at a predetermined price. Now, there's many different types of stop losses you can set, and understanding how to set them in the different types is very important. You have trailing stop losses, limit stop orders, you have guaranteed stop loss orders, and we're going to go through them today. Stop loss orders help to limit your potential loss when a trade goes against you, but it also helps you to lock in profits as a trade is moving in your favor. And this is what a lot of traders don't realize, that they can slowly move their stop losses up, whether they're trailing stop losses automatically move up, or limit orders, and move them up as the price moves in their favor. So if the market whips against you, you get stopped out, but you get stopped out with your profit. So after a trader opens a long or short position by placing an order with the broker, they will often add a follow-up stop loss order to limit the amounts of money they can lose if the investment moves against them. This order stays open until it reaches the stop price, and at that point, the order becomes a market order and executes. Now, today's technology allows us, it used to be that you had to place an actual opposing order. Today, you don't have to do that. Today, when you open up your trade, you can put in a stop loss order by simply opening up your trade and putting in where you'd like that stop loss order. If you're putting a trail and the system automatically does it all for you. And actually, once your trade closes, whether you trade it, whether it reaches your take profit point, no matter how, that stop loss order goes away also. Okay. So if it's not executed, it goes away. So a stop loss order protects profits and limits risk on an investor's open position by exiting at a predetermined price. Now, because it's a market order, there is no guarantee that the order will execute at the stop price due to slippage. Okay. When a market gets very volatile and you've placed your stop loss order, it's no different than you're placing an order. And if you say you want to sell something at $45 and the market's extremely volatile, means the market sell order will get tripped at that $45, but it might only be executed at $44.95 because of slippage. If you're trading CFDs, you don't have that problem. Another side of that's a guaranteed stop loss. Okay. So a stop limit order, which executes as a limit instead of a market order, can help alleviate this problem with one significant risk. The order may never execute if the limit price is not hit, causing substantial losses. But trading without a stop is an ultimate recipe for disaster. Anyone who makes an argument for not using stop orders is most likely not a very successful trader. You know, there's always people out there that know better than everybody else, because a stop loss order or a stop loss is quite unique, because in a volatile market, or even a non-volatile, you can get stopped out when the market is going in your favor, because the markets don't trade in one steady direction. And understanding where to put your stop loss is crucially important, because you don't want to lose money because your stop losses are too close. Now, when you're trading, the only time you have a complete objectivity is prior to entering your trade. When you haven't entered your trade yet, you're completely objective. You're sitting on the sidelines. You're developing a plan. This is when you should be looking at where you want to place your stop loss, what you'll do with what kind of stop loss, because now you're objective. Once you're in the market and the market starts moving, you're no longer objective and you get emotions in the way. So if you have a plan, whether you're trading with a trailing stop loss, a set stop loss, if you say in your plan, okay, when price moves 25 pips in my favor, I'm going to move my stop loss up 20 pips. Okay. Or I'm going to sell half of my asset and move my stop loss up farther, whatever you have. But this should be decided before, not as a reaction to the markets. Stop loss provides many benefits and one drawback. Automatic execution ensures traders limiting their loss at a predetermined level, preventing loss aversion. Placing a stop loss or advance with the broker enables a trader to step away without monitoring the markets. But as I mentioned, as the markets get more volatile, or just a little volatile hiccup in the market for a second can cause you to get stopped out when the market is doing exactly what you thought it was going to do. So a stop loss has one primary risk: volatility causing you to hit your stop price too frequently, eroding your capital due to fees and slippage. So we'll look at the optimal stop loss placement further in this class. Now, traders usually place stop losses on every trade using one or two strategies: the exit method for every trade, or the worst case scenario. While stop loss orders help minimize losses, they can also protect gains. Trailing stop losses can help provide profit protection. Now let's talk about an initial stop. This type of stop loss is meant to protect your capital. Even pro traders find that they don't always make winning trades. If you're a very good trader and very slow trader and only taking high probability trades, you're still only going to trade maybe at 6 to 10 correct trades against losing trades, maybe 7 to 10. Because the whole idea is to limit your losses on those losing trades. So when you make profit on those profitable trades, it covers your losses. So what you need to do is make sure your losses are minimal, that your 3 profitable trades or 4 profitable can cover your losses for the 6 losing trade, because nobody's going to do any better than that. Now, trailing stop loss is probably the most neglected or most non-used stop loss in the marketplace, when it's probably the best to use. This stop loss is more fluid than initial stops and is designed to protect your profit. Once the trade begins to move in to trend in the direction of your favor, you could follow the trend by moving your stop. You could also decide to collect if your trade hits a profit target. Once you learn how to protect your profits as well as your initial capital, you could be well on your way to being an expert. Then we also have a break-even stop. This stop loss is self-explanatory. Break-even stops could help lock in a no-loss trade. They are best suited once the trade has begun to move in your direction and there is little threat of your initial stop being hit. In other words, you open up a trade on Facebook or whatever, X, Y, and Z stock at $45, hoping it's going to move to 50. Well, it moves up to 47. You initially had your stop loss of 43. Your price was 45. Your goal was 50, and it moves up to 47. You could move your stop loss up to 45, the end place where you entered the market. So if the market moves against you, you have a break even. You don't have any potential of having a loss. Me, I would have sold half of my trade at the $47, moved my stop loss up to 46, and if the market moved up to 50, kept moving it up and selling half of my position. But that's just one strategy. Now, there are 2 types of stop loss orders: stop orders and stop limit orders. Sell stop orders protect your position by triggering a market order to sell if you're long when the market falls below a defined level. A buy stop order will protect a short position, just the opposite, just the mirror images. Similar to a stop order, the purpose of a stop limit order is to minimize losses, but as the name states, there is a limit at which your order will be filled. Stop limit orders guarantee price but not execution. Now, stop limit orders are interesting. They're a little bit complicated. But I tell the computer that if my asset falls below the 45, to execute my stop order, but execute it at 43. But if the thing does never, or I tell it if it drops below 43.50, execute at 43. There are two price defines when using stop limit orders. The stop price at which the order is triggered and the limit price in which the order will be filled. Obviously, there's no guarantee this order will be filled, especially in high volatility or illiquid markets. So for example, let's assume Joe, you're Joe today, is short 1,000 shares of X, Y, and Z stock at $30 per share. So he's got a $30,000 investment. He places a buy stop limit order at $35 with a limit order at $35.50 to exit him from his position. X, Y, and Z begins moving up against him and hits $35 per share. At this point, his limit order to buy at $35.50 is triggered. The risk Joe is taking is that the market is illegal and moves above $35.50 before he is filled. He won't be filled until the price drops back below his $35.50. So like a stop order, the purpose of a stop limit order is to minimize losses, but as the name states, there's a limit at which your order will be filled. Stop limit orders guarantee price, but not execution. And then back to my favorite, trailing stop orders. They follow the price and can protect profits while providing downside protection. With a trailing stop order, you do not have to adjust for price changes regularly. So an example is stock A is trading at $100. So we go from X, Y, and Z to stock A, and we place a 5% trailing stop order with our broker. The stop price would be 95% of the high price, or $95. The next day, the stock trades to 120. Our stop would automatically move to 114. So at 114, we've already locked in our $14 profit. So if the market turns against us and we get stopped out, we got stopped out, but with $14 profit. And we're still $6 away from the price of where the price was. The following day, the stock drops to 114, hitting our stop. And our broker places a market order where our price, due to slippage, is filled at 113. We made $13 in the trade as we purchased the stock at 100 and sold it automatically through the trailing stop loss. The trailing stop loss will continually move based on the moves in the market. So now we get a little bit more complicated. We get a fixed trailing stop, which will be automatically moves with your stop loss by a fixed amount that you define as the trade moves in your favor. Your position must move a certain number of ticks, pips, or points defined by you before the stop to move. So for example, Facebook, or stock A, stock FB, there we go, is at 117.30 with an initial stop at 20 cents with a fixed step at 10 cents. So for example, you go short Facebook at 117.30 with your initial stop at 20 and your fixed stop at 10. When the price declines and hits 117.20, that's a 10-cent decline. Your stop would automatically move down 10 cents to 117.40. So as you've seen, your stop would continue to move down by 10 cents for every 10 cents that FB declines in your favor until the stop was hitting close to your position. You would have been stopped out on this trade at 117. So like a fixed trailing stop, a dynamic stop automatically moves your stop as your position goes in your favor. However, with the dynamic stop, your stop loss will move for every tick per pip that the market moves in your favor. So let's do it again. For example, once you decide to short FB at 117.30, your initial stop would be at 117.50. Now remember, we're trading the stock to go down. So to lose or move against us, it would have to go up. So our initial stop is placed at 117.50, 20 cents above where we entered the market. Now your stop loss begins to move down by 1 cent for every cent Facebook or FB moves in your favor until your stop is hit. This trade hits a low of 116.72, which moves our stop down to 116.92, at which point the market bounced and took you out of the trade. Now, I understand today Facebook is metaverse, but because we're not giving you trading advice, we're using X, Y, and Z. Old Facebook, we're using A stock. Okay, because we're not giving you trading advice as to jump in the market and do this if something is trading at such a level. And I should have not used Facebook. I should have just used stock X, Y, and Z, or A, B, and C, or 1, 2, and 3. Then we also have swing highs and swing lows. This is my personal favorite stop loss management strategy, and this is a strategy. Market volatility changes, and using swing high and swing lows to manage your stops allows you to appropriately react to that volatility. Swing highs are the peak reached on a security when the high of the price is greater than the surrounding price action. A new swing high is made when price breaks down to that new swing low. When a security is making highs and lows, it's in a downtrend. Swing lows are the troughs reached on a security when the price is lower than a given number of low positions around it. Or the opposite, a new swing high is made when it's making the peaks. Now, unfortunately, a computer can't do this. This is a manual stop loss. And you enter based on the swing highs and swing lows, and you're constantly making manual adjustments to your stop loss. So using moving averages is just also is another great way that you will have to manually trail your stop loss. Setting stops is a very underrated and misunderstood concept in trading. Your stop loss placement impacts your trading performance on so many levels. It decides over the risk-reward ratio of your trades and thus determines the expectancy of your trading system. It also determines how adequate your trading system or trading strategy is overall. In trading, there are 3 different stop loss types that we're going to discuss. The first is confluence. Confluence stops are the most used stop loss. For confluence stops, traders use moving average support and resistance levels, previous highs and lows, and Fibonacci retracements to determine a fixed stop loss entry number. So the cons is traders usually use very obviously price levels. But the tips are, if you notice that price repeatedly takes out your stops by just a few points, either add more confluence levels or add a little padding to your stop loss and set outside of the danger zone. You always want to set outside of where you think you get stopped out, because if you got to set it because of your risk management somewhere within that zone, you're going to get stopped out. So you're better off not making the trade. And then volatility stops. Volatility stops are often used by professional traders, whereas the average retail trader is often not even aware of this technique. Throughout the market Wizards book series, you can see that many traders follow a volatility-based stop loss approach. So what is a volatility stop? It's a stop loss method that adapts to changing market conditions. When volatility is high, traders use a larger stop loss to account for greater market swings. When volatility is low, use a more conservative method. Bollinger Bands is a great way to see market volatility. When you see how volatile or contrite the market is, you can then adjust your stop losses. And then we have time-based stops. Time-based stop loss approach can also be used in addition to confluence and volatility stops. It's a more dynamic variable for stop loss placement rather than a standalone technique, which helps traders put price and their trade in relationship to the markets. So to use a time-based, you would enter a trade, then you look, nothing happens, so you get out and your signal is probably not very strong. You enter a trade and price immediately moves in your favor. Manage your trades accordingly. Move your trades or your stops accordingly also. You enter a trade and price moves against you accordingly. Get out and don't wait for the full loss if the momentum is against you. How often do you enter a buy trade but nothing happens for hours afterward and the price has hovered around your entry price? If you bought a stock and anticipated higher rising price but nothing happened and your trade just goes nowhere, it's very likely that your trade idea is not working out. In such cases, traders would do better to exit the trade and wait for the next trading signal. So say to yourself, okay, I'm going to set my stop loss here in case the market moves against me and to protect me. But in 1 hour, if the market hasn't started to move in the direction I expected it, I'm just going to close my trade. You close it with no loss. So a time-based stop loss approach would suggest exiting trades with long phases of inactivity or sideways movement. Another example where a time-based stop can be useful to enter when you enter a trade and it goes against you right away. If you bought a stock because the price action pattern or other technical triggers suggested higher prices, but the trade doesn't unfold as anticipated, it's usually a better idea just to exit the trade. The old saying goes that cutting losses is important. So just because it hasn't moved against you and hit your stop loss, but it's moving against you, just get out of the markets. A time-based stop loss helps you avoid being exposed to uncertain or other than expected trading scenarios. Never forget your original analysis and your trading idea is what you are trading, not what the market is doing. You're trading what you had laid down as your trading plan before you open the trade. So ultimately we have confluence stops, volatility stops, and time-based stops. The good news is that all previously discussed stop loss types can be combined in an efficient way to take your stop placement to the next level. Whereas the confluence stop is your basis of how you determine where to set a stop in the first place. And don't forget adding extra padding. Volatility and time-based stops are added on, which add a layer of robustness and professionalism to your stop loss game. So thank you very much for joining us and have a great trading day.